In 2008, one bank filed for bankruptcy on a Monday morning. By Friday, stock markets across 6 continents had collapsed. 28 million people lost their jobs. $10 trillion in wealth disappeared in 15 days. No war, no earthquake, no pandemic, just one bank, one Monday morning, one decision. This is how Lehman Brothers stopped the entire world economy. In 72 hours, how one bank's collapse stopped the world economy. On the morning of September 15th, 2008, a Monday, the fourth largest investment bank in the United States walked into a federal courthouse in Manhattan and filed for bankruptcy protection. The filing was 2,909 pages long. The debts listed totaled $619 billion, the largest bankruptcy in the entire history of human civilization. The bank's name was Lehman Brothers. It was 158 years old. It had survived the American Civil War, 2 world wars, the Great Depression, the dot-com crash, and a dozen financial crises in between. It did not survive the morning of September 15, 2008. Within 24 hours of that filing, global stock markets began falling simultaneously across every time zone. Within 1 week, credit markets worldwide had frozen so completely that businesses could not borrow money to meet their payrolls. Within 1 month, governments on 6 continents were announcing emergency bailout packages, interest rate cuts, and economic stimulus programs of a scale never attempted in modern history. Within 1 year, 28 million people globally had lost their jobs. The International Monetary Fund estimated that the total cost of the Lehman Brothers collapse, measured in lost economic output, destroyed wealth, and government bailout spending, reached $10 trillion. One bank, one morning, $10 trillion. To understand how this was possible, you have to go back much further than 2008. You have to go back to the mid-1990s, when American housing markets began a transformation that would eventually create the most dangerous financial time bomb in modern history, and when the people most responsible for building that bomb were celebrated as geniuses rather than warned as criminals. Lehman Brothers was founded in 1850 by 3 German immigrant brothers, Henry, Emanuel, and Mayer Lehman, who started as a dry goods store in Montgomery, Alabama, before pivoting to cotton trading and eventually becoming a major commodity and investment firm in New York. By the 20th century, it had evolved into a full-service investment bank, surviving every major financial catastrophe the modern era could produce. Its longevity was a source of institutional pride. The firm believed and made others believe that it had a kind of inherent resilience, that 158 years of survival was proof of something fundamental about its culture and its model. That pride was its first vulnerability. During the early 2000s, under Chief Executive Dick Fuld, known internally and externally as a gorilla for his aggressive, domineering style, Lehman made a strategic decision that would ultimately destroy it. The firm decided to massively increase its exposure to the American real estate market, specifically to a new financial product that Wall Street had invented and was selling with enormous enthusiasm: the mortgage-backed security. A mortgage-backed security worked like this. A bank would issue mortgages to home buyers, including, increasingly, home buyers who had very poor credit histories, low incomes, and little ability to repay. These mortgages were called subprime mortgages. The bank would then bundle thousands of these individual mortgages together, slice the bundle into layers of different risk levels, and sell pieces of these bundles to investors around the world as financial securities. The investors, pension funds, insurance companies, other banks, sovereign wealth funds, were told by the credit rating agencies that these securities were safe. Many of them were rated AAA, the highest possible credit rating, the same rating given to United States government bonds. The rating agencies were wrong, catastrophically, structurally, and in some cases knowingly wrong. The reason these securities were not safe was brutally simple. They were only as valuable as the mortgages inside them, and the mortgages inside them were being issued to people who could not repay them. People who had been approved for loans by banks that no longer cared whether the loans would be repaid, because they were selling the loans to Wall Street before the first payment was ever missed. The incentive structure of the entire system had been corrupted. Banks that issued mortgages made money at the moment of issuance and then passed the risk to someone else. Wall Street banks that packaged mortgages into securities made their fees at the moment of sale and then passed the risk to investors. The credit rating agencies were paid by the banks whose products they were rating, a conflict of interest so obvious that it should have been illegal and perhaps should have been stopped long before it was. The investors who bought the securities trusted the ratings. Nobody along the entire chain had a genuine financial interest in asking the only question that mattered. What happens when the homeowners stop paying? Lehman Brothers did not just buy these securities. Under Dick Full's leadership and the strategic direction of his Chief Operating Officer Joe Gregory and Chief Financial Officer Aaron Callan, Lehman had borrowed enormous sums of money to buy them. At the peak of its exposure, Lehman was operating with a leverage ratio of approximately 30-1, meaning that for every $1 of its own money it had invested, it had borrowed 30 more. This is a leverage level that leaves virtually no margin for error. If the value of your assets falls by even 3%, your entire equity is wiped out. And by 2007, the value of mortgage-backed securities was beginning to fall. Slowly at first, then faster, then in free fall. The American housing bubble had been building for years. Home prices had risen so fast, for so long, that an entire financial system had come to assume they would never fall significantly. This assumption was the foundation of every model, every rating, every risk calculation that the banks and the rating agencies had produced. When home prices began declining in 2006 and 2007, and subprime mortgage defaults began rising sharply, every model broke simultaneously. Securities that had been rated AAA were suddenly worth a fraction of their face value. Banks that held these securities were suddenly sitting on losses they had not prepared for, had not disclosed to their investors, and in many cases did not fully understand themselves. Throughout 2007 and into 2008, Lehman continued to insist publicly that its losses were manageable, its capital was adequate, and its business model was sound. Dick Full, in particular, projected absolute confidence in public, the same confidence that had made him a celebrated figure on Wall Street for 2 decades. Behind the scenes, the reality was very different. The firm's real estate losses were accelerating. Its access to short-term funding, the overnight loans that investment banks relied on to finance their daily operations, was becoming increasingly expensive and difficult as counterparties grew nervous about Lehman's health. And Full's response to every warning, from inside the firm and outside it, was consistent. He refused to raise enough capital to cover the losses, refused to sell assets at prices he considered too low, and refused to believe that the firm he had led for more than a decade could genuinely be in existential danger. By the summer of 2008, Lehman's stock price was in steep decline. Short sellers, investors who profit when stock prices fall, were circling the firm publicly. The market had lost confidence. Full desperately sought a buyer or a strategic partner. Talks were held with Korea Development Bank, with Bank of America, with Barclays. All of them ultimately concluded that Lehman's losses were too large and too uncertain to justify an acquisition without government assistance. And here, the story arrives at its most consequential decision point. Over the weekend of September 13th and 14th, 2008, senior officials from the United States Treasury Department and the Federal Reserve gathered at the New York Federal Reserve Building with the heads of the major Wall Street banks, trying to arrange a private sector rescue of Lehman Brothers, similar to the rescue that had been arranged for Bear Stearns 6 months earlier, when the Fed had effectively guaranteed Bear Stearns assets to facilitate its acquisition by J.P. Morgan Chase. The difference this time was that Treasury Secretary Hank Paulson, under enormous political pressure not to be seen as repeatedly bailing out reckless Wall Street banks with public money, had decided that there would be no government guarantee. Barclays, the British bank that was the last serious potential acquirer, walked away when it became clear that no government backstop would be provided. Bank of America had already pivoted to acquire Merrill Lynch instead. On Sunday night, September 14th, 2008, with no buyer and no government rescue, Lehman Brothers had no choice. The filing went in at 1:45 a.m. on Monday morning. What happened next revealed something that the people who had decided not to rescue Lehman had badly, perhaps criminally, miscalculated. Lehman Brothers was not just large. It was interconnected with virtually every major financial institution on Earth in ways that no one had fully mapped. It had counterparty relationships, derivative contracts, securities lending agreements, repo transactions with thousands of institutions globally. The moment Lehman filed for bankruptcy, all of those contracts became uncertain. Nobody knew exactly what their exposure to Lehman was, because the derivative markets were opaque and unregulated. Nobody knew which of the securities they held had Lehman as a counterparty. The uncertainty itself became the crisis. Banks stopped lending to each other entirely. The overnight lending market, the circulatory system of global finance, seized up completely. Within days, insurance giant AIG, which had sold hundreds of billions of dollars of insurance contracts on mortgage-backed securities, required an $85 billion government bailout to prevent its own collapse from triggering a second catastrophic wave of failures. The global economic consequences unfolded with devastating speed. Stock markets in the United States, Europe, Asia, and Latin America fell simultaneously and dramatically. Iceland's entire banking system collapsed within weeks. Countries from Hungary to South Korea to Mexico required emergency assistance from the International Monetary Fund. The credit freeze spread from financial markets to the real economy. Businesses that relied on short-term borrowing to fund their operations found that credit had simply disappeared. Companies began laying off workers not because their businesses were failing, but because they could not access the financing they needed to meet their basic operating costs. The unemployment rate in the United States rose from 6.1% in September 2008 to 10% in October 2009, the highest level since the Great Depression. The government response, when it finally came, was massive and unprecedented. The Troubled Asset Relief Program, TARP, authorized $700 billion in government funds to stabilize the banking system. The Federal Reserve slashed interest rates to near zero and began an unprecedented program of asset purchases, quantitative easing, that would eventually total trillions of dollars. Similar programs were launched across Europe, Asia, and beyond. The scale of government intervention required to stabilize the global financial system after the Lehman collapse dwarfed anything attempted since the Second World War. What became of the people responsible? Dick Fuld left Lehman with approximately $500 million in compensation collected over his years at the firm's helm. He was never criminally charged. No senior Lehman executive was ever sent to prison for the firm's collapse. One mid-level trader at a different firm, Kareem Sarajeldin of Credit Suisse, became the only Wall Street executive to serve prison time for conduct related to the 2008 financial crisis, receiving a 30-month sentence for mismarking bond prices. The architects of the mortgage securities market, the credit rating agencies that misrated them, the executives who leveraged their firms to breaking point, and the regulators who failed to see it coming, none faced criminal accountability commensurate with the scale of harm caused. The 2008 financial crisis produced the Dodd-Frank Wall Street Reform and Consumer Protection Act, the most significant overhaul of American financial regulation since the 1930s. It established the Consumer Financial Protection Bureau, imposed new capital requirements on banks, created mechanisms for the orderly resolution of failing financial institutions, and attempted to bring greater transparency and regulation to the derivatives markets that had spread Lehman's failure globally. Whether these reforms were sufficient remains a subject of genuine debate among economists and financial regulators. What is not subject to debate is what the Lehman Brothers collapse demonstrated about the nature of modern financial systems. It demonstrated that the connections between financial institutions have become so dense, so complex, and so opaque that the failure of a single firm could propagate catastrophic damage across the entire global economy before any regulatory authority had time to understand what was happening, let alone respond effectively. It demonstrated that the incentive structures that had been allowed to develop in mortgage origination, securities packaging, and credit rating had created a system where the people generating the greatest risks bore the least of the consequences when those risks materialized. And it demonstrated something more uncomfortable still, that the confidence of experts, the confidence of bankers, regulators, economists, and rating agencies had been so thoroughly misplaced for so long that when the system broke, almost nobody in a position of authority had genuinely believed, right up until the moment it happened, that it could. Lehman Brothers lasted 158 years. It took 72 hours to bring the world to its knees.